Alright, and welcome to another video. This is just a bit of a walkthrough of the weekly S&P 500 chart storm. The point of this is just to add a little bit of extra context and comments over the YouTube video format or sound format if you're only just listening to this. If you are watching as well, I will be going through the charts as we go through this. Just will also make notice to or reference that we have a new microphone, so the sound quality should be hopefully much improved for anyone who's been a regular listener. So let's start off on the first one, which is 200-day moving average breadth. Now, the reason why I've included this, and not just this week, but almost as running features, we've had here a bit of bearish breadth divergence going on, and the key way that is expressed here is really the lower highs on the breadth versus higher highs on price, and just the fact where breadth is tracking at the moment is actually it's fairly soft, so it sort of reflects an underlying weakness in the market, and that's probably one of the key sort of bearish sort of undertones of something that will give you a sort of a bearish bias at the moment. The second one is another breadth chart, and what this one is the percentage of S&P 500 stocks at 52-week lows. So this is one half of the 52-week new highs, new lows indicator. Now, the reason I included this one is because I noticed that there's sort of, I guess you could kind of call it an uptrend in 52-week new lows here. You can see that certainly you're starting to get, it's having a few more episodes, and the reason why that's meaningful is, you look at the lead up to the 2015 correction in September. There was that kind of build up, fairly steady build up, and then more and more spikes in this indicator as well. So it's pretty informative on that front, I think. And then you also had another sort of somewhat unrelated but similar episode going into the second part of that correction in the early stages of 2016. So I would say that you look at those two, and the breadth picture on those two at least is sort of looking, certainly got a bearish skew to it. The second chart, or the third chart rather, is the PE ratio for the S&P 500 and the US 10-year bond yield. So bond yield's inverted, and it is a relatively short space of time, but the idea here is that the fall in bond yields is being a supportive influence for PE ratios, and there's a bit of logic to that, in that the 10-year bond yield, if that feeds into your discount rate, then your valuation should be going up, all else equal. But then I've noted here in the actual tweet that this is a correlation that's going to work until it doesn't, which it's a bit of a tautology. But the reason why I say that this is not going to that it's going to work until it doesn't is that bond yields go down further. That's going to be reflecting more of a deterioration in the fundamentals, which the PE ratio is not going to hold up in that kind of scenario. So so if you have a real big step change lower in bond yields, then that's going to break that correlation by PE ratios falling. And then by the same token, if you get a real resurgence in inflation, growth, big re-acceleration, then that's going to send bond yields back up. And if that's supporting earnings, then that's again, they're going to go in the opposite direction. So I don't know, I'd call this a temporary thing. It has some validity to it, but it's more of a sort of a temporary thing. Note in passing. Chart number 4 is from All Star Charts. Very well worth following. Good follow on technical analysis there. And what he's got here is a trend line against the gold versus S&P 500 ETF ratio. So this is gold versus stocks, and you can see there that after a significant period of underperformance, it's poking its head above that trend line, and that's going to be one to watch because, you know, I mean, you think about the golds versus stock ratio, there's potentially a bit of information in there, you know, from a risk standpoint. You know, it's generally understood, and it usually works this way, that gold performs better in risk off, or, you know, environments where you know, risk appetite is waning, and, you know, the opposite is true for stocks. So, you know, from a sort of information standpoint, it's kind of interesting, but then even just as a trading thing, you know, that breaks out in a meaningful way that could be quite interesting. Which reminds me that I have to go away and have a review of my gold outlook, which will probably be featuring in the upcoming edition of the weekly macro themes report. Previously held a bearish view on gold for a number of good reasons, and be worth reviewing that because things are starting to stir on the price front. Number 5, not a huge amount to say about this except that how remarkable it is. And this is the rolling count of months without a 3% correction. And, you know, it's been quite some time now. Not much more to say than that. You know, it's more of an observation than a prediction. But, you know, it only got slightly longer than this in the early 90s. You know, be careful what you wish for. Number 6, kind of related to that, I guess, in a way, and related to what we've previously talked about. You know, September, on average, is your worst month for on average. This is the worst month for performance for the S&P 500. Certainly, you know, the 2015 correction came in September, which is it's a coincidence and not a coincidence at the same time. Thing to note about this is that it is just a long-term average stats, and as you'll see on the next table, and may as well just go straight into that, which is number 7. The percentage positive kind of gives you a bit of, you know, extra context there. So September, worst month on average, but then you look at that, 45%. So yeah, the majority were negative at 55%, but with 45% of months throughout that period positive, you know, it's 50-50 basically. So you know, if it was much lower than that, then they would probably have significantly more meaning. But I guess the point to note there is that it's generally a weaker month, and it's sort of the climax of a generally softer, or generally the softer part of the year. October, it is worth noting, is what you call the wildcard month. So you look at the best worst months on record. October had the best and it had the worst, and unsurprisingly, and for other reasons, it also has the highest standard deviation, and that means the greater sort of uncertainty or movement around that average. So, you know, one standard deviation underperformance would be -5. So, and, you know, +7 on the other end. And so that's quite, you know, something to really bear in mind, particularly on the back of the expected negative seasonality in September, which kind of lines up with a long list of potential bearish catalysts and, you know, those other bearish signals that we talked about earlier. And, you know, just for the record, I'm not, you know, a perma bear or one of those guys out there making wild bearish predictions. I'm just looking at the statistics and charts and drawing my own conclusions and interpretations thereof. And if you've got other interpretations or other ideas, then please do put them in the comments of this video. And moving on to the next one, speaking of bearish stuff, here is another one. This is the implied correlation index, which is kind of the cousin to the CBOE VIX or volatility index. It's also derived of option prices, and it is giving you the implied level of correlations for S&P 500 stocks. Now, what I've noticed here is that when you get periods of lower correlation. So notice too, by the way, that this red line is inverted. So lower correlation is actually shown as higher up on the chart. It's important to note how when you get these periods of lower correlation, they have often occurred at market tops, or sort of periods where the market would pause. So we've got a lot of short-term tops here. I can see in going into 2012, 2011 there. Even around in 2016, sort of occurring prior to brief, small tops prior to that 2015 correction there. So it's quite interesting to note then that you've had had it go down to the lowest reading since just prior to the crisis. And it's worth thinking about what might be driving that. I've got a bit of an article link there, so if you wanted to have a look at that. But lower correlations generally mean that some part of the market's probably doing better than others. And that can be a sign of weakness. So half of the market's doing really well and the other half is doing really bad. And that could be a pretty good reason why you'd have a drop in correlations and then a period of weakness. And it can also be if one sector was doing extremely well, so that one sector was actually in a bubble, that could be another thing that would drive correlations lower. And then on the flip side, when you get a spike in correlations, I mean, just go back to that one of those investing or financial market rules of thumb, is that whenever you have a moment of panic, or a moment where everything's, it's that whole sell everything, then correlations tend to converge towards one. And so, a spike in correlations as you got at that point there, so in 2012 at the bottom of the market there, and again in 2010, less distinct relative to history, but you also got a spike in correlations into 2009. So, it's an interesting timing indicator, that one. It's one that we've been keeping an eye on, put it in a recent report for clients. And yeah, the overall message for that is that it's giving a bearish signal at the moment. So on to the next one, sort of turn away from the bearishness to the optimism. And then this is one of those glass half full or glass half empty type of charts. With no true answer except in hindsight. So the first answer is that it's glass half full and that it's about to kick into a virtuous cycle and it's going to stay at these levels for 5 years like it did pre-dot-com bubble burst. And the other one is that it's glass half empty and that it's that it's so good that it's bad, that this is a period of too much optimism. I'll leave it for you guys to debate that one, but certainly an interesting chart. Interesting how it's taken how long it's taken for optimism to recover. You can see this period after the crisis, we had this sort of emotional scarring, but it is worth noting too that the economics have actually really picked up in recent years. And it's kind of mirroring what you've seen in the small business survey and the consumer surveys, which both took a long time to recover. And then the last one is the little bit of data from fact sheets showing that in this pretty narrow window here, that companies with greater revenue exposure to Asia have been doing well. I can think of number of reasons behind that. China's generally been doing a little bit better lately. Emerging markets in general have been doing really well, and they've been putting in a lot of monetary support. So it's quite logical to expect a bit of cyclical upturn, which we're starting to see. And global trade has been doing a lot better, so it kind of makes sense. One to note in passing. And that's it. So yeah, if you like this video, be sure to follow the channel and We'll be putting out another video later in the week. Haven't decided what that's going to be on precisely just yet, but it'll be going through the from a weekly report from a couple of weeks ago.